Welcome to Earnings Recap. Today we're covering Intel's Q1 2025 earnings call.
Yeah, quite a bit to unpack here with a new CEO settling in as well.
Exactly. For this deep dive, we've got their latest earnings release and the full transcript of the call itself.
So all the raw data and the commentary directly from management.
Our mission, to really cut through the jargon and get to the heart of what's actually happening at Intel. We want to understand their financial health right now, what the new CEO is planning.
And how they see themselves navigating what's, let's face it, a pretty turbulent market.
Right. It's more than just the numbers. It's trying to grasp the direction Intel is heading, the challenges, the opportunities.
Okay, so let's dive in. Where should we start? Financials.
Let's do it. First off, the financials for Q1 2025. They brought in $12.7 billion in revenue.
Which was actually at the high end of their guidance, so a decent start there.
Yeah, and apparently driven by better-than-expected Xeon sales, their server chips.
Right. Although it's interesting, the CFO, David Zinsner, he did mention that some of this Q1 revenue might have been boosted by customers buying ahead.
Anticipating potential tariffs down the line.
Exactly. It just shows how these big global economic factors can really play into the quarterly numbers,
Makes sense. Okay, what about profitability, gross margin?
So non-GAAP gross margin was 39.2%.
And that was significantly above their guidance.
It was. They said it came from stronger demand for their Raptor Lake chips, the slightly older Gen PC chips.
Okay.
And also getting better costs on their newer Meteor Lake products.
So a couple of positive factors there, and the bottom line, earnings per share.
EPS, non-GAAP, came in at 13 cents. Again, better than they guided.
So higher revenue, better margins. What else helped?
Lower operating expenses. That seems key.
How much lower?
They managed to cut OPEX by $400 million compared to just the last quarter.
Wow.
And $700 million compared to Q1 last year. That's a pretty significant drop.
Definitely signals a real focus on cost control. What about cash flow?
Operating cash flow was $800 million.
Okay. And investments? CapEx?
Growth CapEx was $6.2 billion, but they had some offsets, about $1.7 billion.
So netting that out.
We use an adjusted free cash flow of negative $3.7 billion for the quarter.
Still burning cash on that front then, but what's their overall cash position?
They finished Q1 with a solid $21 billion in cash reserves.
That's a good cushion. And they had some extra cash come in too, right?
Yeah, two notable things. $1.1 billion from the CPS Act grants.
Those government incentives for U.S. manufacturing.
Mm-hmm. And another $1.9 billion from finally closing the sale of their NAND memory business to SK Hynix.
So important cash injections, especially as they're investing heavily in new tech.
Absolutely gives them more flexibility.
Okay, let's break down the performance by segment. The main Intel products division.
That brought in $11.8 billion. Now, that was down 10% sequentially.
But still better than they expected.
Right. Within that, the client computing group, that's the PC side revenue, was down 13% quarter over quarter.
A bit softer than usual seasonality.
Yeah, but they said it was in line with what they expected. Higher volumes were offset by product mix and competitive pressure.
Makes sense. And the data center and AI group, DCAI.
Revenue there was down 5% sequentially, but again, better than anticipated.
What drove that beat?
Seems like strong demand from the hyperscalers, the big cloud companies for CPUs used in AI servers, and also for storage compute.
Got it. And the overall profit for Intel products?
Operating profit was $2.9 billion. About 25% of revenue. That was down quarter over quarter, reflecting the lower revenue.
Okay. Let's switch to the foundry business. How did that look?
Intel foundry revenue was actually up $4.7 billion, an 8% sequential increase.
Why the jump there?
It sounds like some customers pulled in orders for their Intel 7 wafers, and they also saw more demand for advanced packaging services.
That's the complex chip integration stuff.
Exactly, connecting different chiplets together.
But what about the foundry's profitability? Still losing money.
Oh, yeah. The operating loss was $2.3 billion.
Ouch. Is that better or worse?
Roughly flat compared to the last quarter, and pretty much what they expected. They mentioned structural cost improvements are happening, but they're being offset by the huge costs of ramping up their next-gen Intel 18A process. That's expensive work.
Understood. And the last bit, the all-other segment.
That includes Mobileye, Altera, IMS. It brought in $943 million, down 15% sequentially, but slightly above expectations.
Did that part make money?
Yeah, collectively, $103 million in operating profit. And the big news there was the Altera deal.
Right, selling a majority stake.
Yep, 51% to Silver Lake Partners, valued Altera at almost $9 billion, and Intel expects about $4.4 billion in net cash proceeds.
When does that close?
Expected in the second half of 2025.
That Altera move feels like a clear sign of trying to streamline things.
Absolutely. And generating cash, which fits right into what the new CEO, Lip-Bu Tan, talked about.
Perfect segue. Let's talk about him. He was only about 5 weeks into the job at the time of the call. What were his initial thoughts?
He kicked off by saying he joined because he loves the company and sees a real opportunity for a turnaround, regaining market share, driving growth.
Did he think Q1 was good?
He called it a step in the right direction. But he is very clear. Lots of room for improvement. No quick fixes.
What was his main message?
Execution. Laser focus on execution. And the need for fundamental cultural and operational transformation. He didn't mince words.
What problems did he identify?
Things like organizational complexity, bureaucracy, slow decision-making, internal silos.
Yeah.
Basically things hindering innovation and speed.
Sounds like classic big company problems. What's he doing about it?
Taking swift actions, as he put it. Simplifying processes, driving transparency, accountability, empowering smaller teams.
Any specific examples?
Yeah, he flattened the leadership structure. Key areas like product, manufacturing, G&A now report directly to him.
Cutting out layers.
Exactly. And he said this streamlining approach will apply company-wide. Big focus on empowering engineers and making things easier for customers.
What about costs? We saw OPEX was down. Any more plans there?
Oh, yes. Big plans. They lowered the 2025 OPEX target to $17 billion.
Down from what it was expected to be.
Right. And the 2026 target is now $16 billion. Plus, he told teams to find another $2 billion in gross CapEx savings for this year, 2025.
Taking that target down to $18 billion.
Yeah. And they're looking closer at their existing factory footprint for efficiency.
So lots of cost cutting. Is he worried about underinvesting in innovation?
He addressed that. Said they'll still make needed investments by cutting non-core projects. And he talked a lot about revitalizing the engineering core, promoting internally, bringing back talent, recruiting.
And the return to office mandate.
That too. 4 days a week in the office starting Q3 2025. The goal, he said, is fostering collaboration, efficiency, and innovation. It's definitely a notable move.
Okay, what about his longer-term strategic priorities? Any initial thoughts there?
He outlined 3 main areas, sort of initial thoughts. First, best products win. Refocusing on building top-tier products, leveraging their PC and data center strengths.
Adapting for AI.
Yes, adapting the roadmap for AI agents, reasoning models, taking a holistic view. But he cautioned, again, not a quick fix.
Okay, priority 1, best products.
Second was refining the AI strategy. Leveraging his own background, apparently, in AI startups. The goal is full-stack AI solutions for enterprise customers.
Focusing on what aspects of AI?
Things like accuracy, power efficiency, security, especially for reasoning models, what they call agentic AI, and also physical AI.
Interesting terms. And the third priority?
Building trust with Foundry customers. This seemed really important to him.
More than just tech.
Exactly. He said Foundry success is a customer service business built on trust. It needs a customer service mindset, embracing industry-standard EDA tools.
Those design tools engineers use.
Right. And delivering on commitments, initially focusing on Intel 18A, but also working on the next node, 14A.
What are the key metrics for Foundry customers?
He listed them. Power, performance, area, cost, quality, yield, reliability, and hitting schedules on time. Pretty comprehensive.
Makes sense. Any other big strategic points?
Strengthening the balance sheet.
Mm-hmm.
Prudent capital management, given how capital-intensive the business is.
How? Besides the OPEX and CapEx cuts.
Looking to further monetize non-core assets, like the Altera deal. Presumably more to come. Interestingly, they decided not to spin off Intel Capital, their venture arm.
Oh, why not?
Instead, they plan to monetize the existing portfolio and be more selective with new investments. The overall aim is getting the balance sheet healthy and starting to deleverage, pay down debt this year.
Okay, that's a lot from the new CEO. Let's bring in the CFO, David Zinsner. What did he add?
He largely echoed the sentiment that Q1 results reflected expected market trends, the Windows 10 end-of-service refresh, AI PC adoption starting, aging PCs, delayed data center upgrades driving CPU demand.
But he sounded a note of caution too, right?
He did. Pointed to increased economic uncertainty, shifting trade policies, inflation, regulatory risk. Because of that, they're taking a more conservative approach for the second half of the year.
How does that translate into guidance for Q2?
Revenue guidance is $11.2 to $12.4 billion. That's a wider range than usual, reflecting that uncertainty.
And down sequentially.
Yeah, down 2% to 12%. Within Intel products, they expect DCAI, the data center part, to decline faster than CCG, the client PC part.
What about the foundry in Q2?
Expected to be down quarter-over-quarter, partly due to those Q1 pull-ins we mentioned, but also lower wafer and packaging volume and those ongoing Intel 7 capacity constraints.
Those constraints are expected to stick around.
Apparently so. The all-other segment revenue is expected to be roughly flat sequentially in Q2.
And Q2 margins below Q1.
Yeah, expected around 36.5% non-GAAP gross margin. That's lower due to less revenue overall and a mix shift towards outsourced or lower margin client products.
Q2 EPS.
Expected to be break-even non-GAAP.
Okay. Any thoughts on the full year? It sounds pretty uncertain.
Very uncertain. Zinsner suggested starting with the last 10-year seasonality as a baseline for modeling. But be very mindful of the market uncertainty, especially potential tariffs and tight supply on some older manufacturing nodes.
He also mentioned something about non-controlling income.
Right, GAAP NCI. Expected to be about $500 million this year, 2025, but growing significantly after that, maybe $1.3 to $1.5 billion in 2026.
And restructuring charges related to the simplification efforts.
Likely yes, but not estimated yet and not included in the non-GAAP guidance.
Where are the 2025 spending cuts focused again?
Refocusing the portfolio, cutting organizational complexity, transforming engineering, and driving SG&A efficiency. Pretty much aligns with the CEO's points.
What about net CapEx for 2025? Did that change with the lower gross CapEx target?
Interestingly, no. They kept the net CapEx range at approximately $8 to $11 billion.
Why, if gross is lower?
Uncertainty about the timing of receiving the U.S. CHIPS Act funding, so they're being cautious on the net number.
And the balance sheet goal?
Still a top priority.
Yeah.
Start deleveraging, paying down debt in 2025.
Okay, that covers the prepared remarks. Let's get into the Q&A highlights. What were investors worried about?
A big one was balancing their own internal product needs versus filling up the foundry for external customers. How do you manage both effectively?
What was the CEO's take?
He tied it back to flattening the organization. Said it helps focus on the right products and delivering solutions. Laser focus on on-time delivery and performance for key Intel products and for the foundry side.
Priority 1 is ramping their internal customer, first getting Intel 18A running smoothly for their own Panther Lake chip, then improving yield, reliability, and really adopting that customer service mindset with industry standard tools for external clients.
Makes sense. What about gross margin outlook? Investors always care about that.
Yeah, the CFO acknowledged its dynamic, especially with tariffs. He expects the client mix to shift towards Lunar Lake later this year.
Which has lower margins initially.
Right, due to memory and packaging costs. Plus, the Intel 18A ramp-up in Arizona will also pressure margins initially.
When does he see improvement?
He expects improvement in 2026 as they get more Panther Lake volume, which should have better margins, and they pull more wafer production in-house. But tariffs remain a big wild card.
They did beat margin guidance significantly in Q1. Any color on why? Was it a clean beat?
The CFO basically said the top-line revenue beat and a higher mix of those Raptor Lake sales were the main drivers. Without those, the margin would have been closer to the original guidance.
Got it. Were investors pushing for announcements of new foundry customers?
They were, but the CEO pushed back gently, saying priority 1 is ramping internal customers, then building trust with existing foundry clients, focusing on PDKs, schedules, yield, reliability, customer service. It's a phased approach.
Makes sense to get your own house in order first. What about updates on those key 18A products, Panther Lake and Clearwater Forest?
Panther Lake, the PC chip on 18A, first version still expected by end of 2025. More volume in 2026. They say it's tracking well competitively, strong customer interest, ramping similarly to Meteor Lake and Lunar Lake, high performance first, then commercial.
And Clearwater Forest, the server chip. That one's expected in the first half of 2026. They prioritize Panther Lake first. It's described as an E-core based derivative of Granite Rapids with unique packaging.
Okay, what about those Intel 7 capacity constraints? Why are they short on an older node?
Higher than expected demand for Raptor Lake, which is an Intel 7 part. Management framed it as usually a good sign for factory utilization.
And this ties into stronger demand for older parts generally.
Exactly. Both 7mm and 10mm parts are seeing stronger demand. Why? Macro concerns, tariffs, driving customers towards lower price points. OEMs have also ridden down the cost curves on older parts.
So does that slow down the AI PC ramp?
It probably impacts the speed a bit, yeah. But Intel stressed they're still investing heavily in AI PC as a long-term growth area.
Let's talk more about that AI strategy. What's the focus? Reasoning models, Gen AI, physical AI?
The plan seems to be partnering with industry leaders to build purpose-built silicon and software. They want Intel to be the compute platform. Big focus on edge computing and inference, and exploring new low-power architectures.
Back to the cost cuts. That OPEX guidance for 25 and 26, $17 billion and $16 billion. How firm are those?
The CFO sounded confident, said the numbers reflect a leaner, more efficient company driven by cutting bureaucracy in layers. They're still working through specifics like headcount.
But confident they'll hit the targets.
Yes. And maybe even find more savings later. Some freed-up investment might get redirected strategically, too.
What about the data center outlook for the rest of the year? Q2 looks softer.
Yeah, that strong Q1 driven by a few hyperscalers isn't expected to continue in Q2. Plus, the macro concerns and that strong demand for older gen parts are factors.
So what's the focus for data center now?
Stabilizing market segment share, creating margin, increasing average selling prices, ASPs. They feel they have a good product portfolio coming with Granite Rapids and Xeon 6, but challenges remain.
Yeah, especially with market share outside of the big hyperscalers and enterprise segments. Let's talk CapEx again. The $18 billion gross target for 2025. What about beyond that?
They highlighted leveraging about $50 billion in assets, already under construction equipment, basically sitting ready to be installed.
Bubble wrap equipment.
Kind of, yeah. This approach of using already purchased gear is likely to continue into 2026, though no specific guidance yet.
What's the long-term target for capital intensity?
Around 25% in a full IDM model. But that includes balancing internal manufacturing with using external foundries like TSMC as part of their capital strategy.
Given the strong demand for older chips, does that delay Panther Lake?
No, they said the launch timing is consistent with previous launches. They see it as competitive, strong commercial demand for AI PCs. Commercial usually adopts first anyway. They sounded bullish on Panther Lake.
Just to confirm, the Q2 server weakness drivers again.
Strong Q1 from specific hyperscalers not repeating. General macro demand worries, tariffs, restrictions, and that strong demand for older server parts. It's a mix of things.
What about the foundry mix for Panther Lake and the generation after, Novo Lake? How much will be internal versus external?
Goal for Panther Lake is about 70% of the die area built in-house on 18A. For Novo Lake, they'll optimize at the SKU level, using both TSMC and Intel processes.
So potentially some Novo Lake parts made at TSMC.
Yes, but they emphasize more Novo Lake wafers overall will be built on an Intel process compared to Panther Lake wafers. Commitment to internal foundry growth remains, but balancing internal-external is part of the capital strategy.
How were things looking early in Q2 when they gave the call?
A relatively strong start, actually. But the guidance anticipates those macro headwinds, especially tariffs, leading to a softer June.
Any more on the data center AI strategy? They mentioned changing Falcon Shores to Jaguar Shores.
Yeah, they're reevaluating the whole AI portfolio. More details promised in the coming months. The aim is to be aggressive in data center AI with a workload-first approach.
What's the overall timeline for this turnaround? Did the CEO give any hints? Key metrics.
He stressed again, no quick fixes. They're working through roadmaps for CPU, GPU, AI short and long term, considering partnerships for speed. Key metrics. Delivering the best products, especially edge power efficiency and performance, time to market, and just meeting customer requirements consistently.
Does he still believe in the IDM model designing and manufacturing?
Yes, but emphasizes a balanced approach. The internal foundry has to deliver for both internal and external customers simplicity, on-time delivery. But TSMC remains a key partner. They need to drive efficiency and yield internally while working with customers on future nodes like 14A.
Quick clarification. The OPEX guidance, the $17 billion and $16 billion, does that include Altera?
Yes, it does currently. Once the Altera divestiture closes, those targets will be reduced by Altera's spending. But the timing of the close is still uncertain.
Last one from the Q&A. Anything on the broader data center system strategy? Rack scale, networking.
They see the rack scale system approach as important. Leveraging CPU, GPU, XPUs, their IPU products are seeing strong growth. Optics is critical for rack scale, and they highlighted their unique optics-based foundry option. And the Open by 86 ecosystem is seen as valuable for AI infrastructure. They mentioned one large custom design win leveraging that, with more expected.
Okay, let's try and sum this all up. It really feels like a tale of two cities almost. Better than expected Q1 financials.
Right, hitting the high end on revenue, beating on margin and EPS.
But alongside that, a clear acknowledgement of big challenges and a major strategic reset under the new CEO.
Absolutely. Very clear moves to cut costs significantly, a reevaluation of the whole AI strategy, continued big bets on the foundry business for both internal and external customers.
And tweaks to the product roadmap, all while trying to navigate this really complex, uncertain economic backdrop.
You definitely see signs of progress, or at least determined action, especially from the new CEO focusing on efficiency and customers. But the headwinds are real competition. The economy, tariffs.
Execution is going to be absolutely critical.
Just no doubt.
Yeah.
Their long-term success hinges on whether they can actually execute on all these ambitious plans in a very tough market.
Which brings us to our final thought for you listening. Given all these major strategic shifts at Intel and the significant external pressures they're facing, what will be the biggest indicator of success for them over the next year or so? Is it hitting those financial targets? Is it actually gaining back market share? Or is it demonstrating real tech leadership in these new areas like AI?
Yeah, what's the key metric to watch? Definitely something to keep a close eye on.